Let's welcome to second lecture on my YouTube course Market Risks Quant Analyst. So this is a type of market risks. I am creating two videos for the type of market risks. So we will discuss in this video related to the interest rate, FX, liquidity, commodities, and how they are impacted and their graphs and how they are work. So before starting with this course lecture series, I'll request you if you like my video content and my teaching style, and if you find some insights from my videos, so please do like and subscribe my channel. So that's motivate me to create and more videos for you, and that's motivate me to create the 100 plus videos for the quant risks or the market risks analyst role. So you will become a the quantitative analyst. So let's start discussion on these video. So I'll give you the first introduction of the market risks. So the market risk refers to the risk of losses due to the changes in market variable like the interest rate, stock price, currency exchange rate, or the commodity prices. If these are the changes in the market, so FX, equity risk, or the commodity, then what are the impact of your the portfolio after changes on this. So we will study in the market risks that all things, and every investor or the banks or the hedge fund company or the investment bank corporate and expose the sum from of the market risks, and they study on the market risks, and understanding these risks helps the quant and the risk manager being the hedging and the strategies and the trading strategy, or to define the trading algorithm, or to create an optimum portfolio which will give you higher return with the minimum risks. So let's first discuss on the most important factor. We will discuss each factor in detail. So let's start discuss on the very important factor, that is and the interest rate risk. So interest rate risk is comes from the fluctuation in interest rate. So there are the the fluctuations comes in the RBI repo rate, fixed floating rate, or the fixed rate. So that's what are the impact on your portfolio after changes on that fluctuation in the interest rate. So it mainly affect the bonds or the loans or the derivatives, how they are imposed on that. There are the two main types of the rate of interest. First one is a repricing risk and the yield curve risk. So let's discuss on the repricing risk. When a cash flow are exposed to rate change and the different items, so that way we calculate the the repricing risk and the yield curve risk. When when the shape of yield curve is shift, so there is the positive yield curve or the negative yield curve or the flattened yield curve. So these are the types of yield curve. When the positive yield curve, or we say that when the long term interest rate give you the higher return as compared to short term, and the flatter yield curve for there is no fluctuation in the interest rate for your duration of investment, maybe it is a long term or the short term, it is the same rate of interest you will receive. And the negative the yield curve, we say that if you invest in the short term, and you will get the higher return as compared with the long term investment. So example, raise in interest rate due to reduce in the bond prices, and the the interest rate relationship and the bond prices relationships are the inverse relationship. So that is also you need to keep in mind. So let's discuss on the second point, that is a foreign exchange risk. So we also call it as a FX. So FX comes from the change in the currency exchange rate. If the dollar or the other currency, the rate of its changes, then the exchange rate risks will come. And it is a crucial for the multinational companies and the global investor who are invest in the cross border transaction. So let's discuss on the types of FX risk. So you can see on my screen there is a transaction risks or the translation risks or the economical risks. So transaction risks is when making the cross border payment, when you are doing the cross border transactions or making the payment. So that risk is come if the dollar price suddenly increase or decrease. So how you need to changes on the payment. So you use the different hedging strategy to avoid such rate of risk. And the translation risk, when the consolidating financial statement in different currencies. So when you are translation your the financial statement in the different currencies, so how your the portfolio will get impacted after that transaction. And the last one is the economic risk, so long term effect on the competitive and the cash flows, so that comes under the economic risks. And example of this is at the if the INR depreciate against the USD, so Indian importer face the higher cost as compared with the previous cost. So let's discuss on the next slide, which is on the equity risk. So let's discuss on the equity risk. So equity risk as a risk loss from the fluctuation in the stock price. If the stock price are going changes, or the stock, if you are use the call option or the put options, or if you have want to buy some Reliance share or some share in the futures, and if the price of that share is very increasing in the future, so you will pay high cost, and the price will be low, then you will pay the low cost for buying these things. So that's derive the market volatility and the company performance and the economic cycle. These factors is affected, and there are the two types of equity risks in the market, that is a systematic risk and another one is a unsystematic risk. So basically the systematic risk is affect the entire market, like the recession or the inflations. If that factors is affect on the entire market or all the market products. And the unsystematic risk is specifically for that company or that organization. Like that factor is come from the poor earning or the fraud done by the employee or that other management. So the systematic risk is cover the entire market, and unsystematic risk is specifically for the specific organization or the company. And that let's discuss on the for example, a 10% drop in the Nifty 50 affects the equity portfolio, how they will affect on the equity portfolio. So let's move on the next slide, that is the commodity risk. So what is and the commodity risk? So commodity risks arise from the price fluctuation in oil, gold, or the agriculture product or the agriculture inputs. So so it's example by supply and demand, geopolitics and weather conditions that are affected on the commodity risks. And the example of the commodity risks are the spike in the crowd oil prices raises cost, and airline and transport companies to change their the prices. And hedging can be done using the future option and the swaps in the commodity market. So commodity market is a very huge market, and we will discuss in detail how to do the pricing, how to do the future pricing, option pricing in the commodity market in upcoming slides. So let's discuss on the comparison of the market risk factor. So we will discuss on the risk type and the driver and the example, and what are the instrument you are going to use to hedge something. So let's some that the risk type. So let's market risk is an unavoidable but manageable factor. We are not avoid that market risk, but we need to manage it, these things. A quant analyst must understand these risks to build the modern strategy and the risks and hedging funds for the market risks. And the goal is not to eliminate the risk but measure, control and optimize it to gain more profits with the low risk. And managing the risk, the key success for finance training and the investment career for the quantitative analysis. So in this slide you can clearly see that the factors and drivers. So let's move on the conclusion slides. So market risks arise an unavoidable but can be manageable factor, and understanding the interest rate risks and the FX and commodities risks are essential for the quant analysis, and to understand how they are functionally and technically work on the market, and how they are impacted and influencing on the market. So proper measurement and hedging reduce the potential losses that faced by the portfolio or the investment firm or the hedging firm. So that's the end of very important topic, guys. And I'll going to upload another videos on same, so you can get more knowledge on that side in the market risk factors. So let's thank you so much for attending my this video series. Once again, thank you so much, guys. If you like my video content, so please do like and subscribe my channel, so that's motivate me to create and more such videos for you. Thank you so much once again.